Hi everybody, Jeff Yasteen here. You know, the coronavirus sell-off reveals an eternal truth about Wall Street's advice. Strategists and analysts love stocks when they're trading at high prices, but nearer to the lows where investors ought to be buying, where there's less risk, these same experts aren't so sure. They withdraw their recommendations. As a former financial journalist and as an investor, I've seen this story play out again and again over the years, and I'm seeing it play out now. Analysts make any number of excuses why they won't recommend stocks at a time like now when many company shares are trading down 20 or 30% or more. They'll say that they can't model the financial impact, that the virus represents a headline risk. Well, of course it does. And the outlook on the economy is therefore cloudy. Well, when it comes to the coronavirus, all those statements are true. But if you're looking for certainty, the only thing that approach guarantees is that you're going to be buying stocks when they are much higher rather than lower, as dire as the situation may seem right now because of the sell-off over the last 2 weeks. Case in point is Facebook. The shares are down 18% from the all-time highs of a handful of weeks ago to this week. Much of Wall Street's analyst community has already soured on the stock. Last year, they worried about an exodus of Facebook executives. Then they were concerned that direct-to-consumer companies would cut back their ad budgets. And hovering over all of it now is the impact of the coronavirus on the global economy. Yet the company this year will still earn north of $9 and nearly $11 a share in 2021. And if we divide next year's earnings projections by Facebook's current $174 share price, we get a price-earnings ratio, a multiple of 16. Now, that just happens to be the company's lowest forward price-earnings ratio in its whole history, its 8-year history as a publicly traded company. Now, let's not forget, we're talking about a company that generates massive amounts of cash flow. At some point, Facebook will pay a handsome dividend with that cash that it generates each quarter, just like Microsoft decided to do when it paid a dividend for the first time in 2003, and like Apple did in 2012. Now, until then, that cash, nearly $55 billion worth, up more than 30% from a year ago, sits on Facebook's balance sheet. That cash represents Facebook's war chest. Mark Zuckerberg may or may not be the CEO to lead the company out of the Wall Street doldrums. No doubt the company will also face a myriad of legislative threats, including calls for more regulation or even a breakup of the company, although I doubt that would happen for Facebook in particular. But with the money that Facebook has now, it can buy, build, or hire whatever or whoever it needs to propel the company stock from its bargain price right now. Lastly, advertising trends continue to move in Facebook's direction. According to Tech Radar, this year will mark the first time that Facebook, along with Google, will bring in more ad dollars than the entire global TV sector. They estimate the two companies alone will generate more than $230 billion in ad spending. Coronavirus or no, they see TV ad spending rising by at least 2.5% this year. So my point here is that if Wall Street analysts wanted to do right by their customers, they'd be recommending the stock to buy now instead of running away from it. I'm Jeff Yasteen. Remember to keep following me on social media, subscribe to my YouTube channel, and until then, I'm wishing you the best of goodbyes.